Uber stock is up almost 55% year to date in 2025, and I still think it's the best stock to buy right now. It's outperforming the S&P 500 index by nearly 10x. And I'm going to share with you in this video why I still like Uber as the best stock to buy, even though, of course, I like the stock better to start 2025 at the significantly lower valuation. I still like the stock even over $93 a share.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Uber last updated investors after the end of the quarter, which ended March 31st, 2025. And in that report, it reported several critical metrics improving, including the monthly active platform customers, which jumped by 14% to 170 million. Uber has had the early mover advantage in this category, collecting users when the cost to collect users was much lower than where it is today. Companies like Tesla that are trying to develop driverless car technology and roll the technology out by themselves without partnering with a company like Uber will find it so expensive to collect these amounts of customers. They like to tout the lower cost of producing the vehicles to deliver to customers, but they fail to point out how expensive it's going to be to acquire users. Many times, the customer acquisition cost can be an impediment for a business growth. And in this case, Tesla might find it extremely difficult to attract even a fraction of the monthly active platform customers that Uber's been able to attract over its many years in business. Uber's gross bookings jumped by 14% to 42.8 billion. Now, this isn't all revenue for Uber. This is just how much money gets spent on the Uber platform. Some of that money goes to restaurants and some of that money goes to drivers, and Uber gets a percentage of that overall booking. But this does highlight how much money people are spending on Uber, which signifies the customer value proposition. If you read my book, The Six-Step Framework for Evaluating Publicly Traded Companies, you'll know that one of the 6 steps I look at when I'm evaluating a business is the customer value proposition. And I think Uber offers customers a great value proposition. Convenience, convenience, convenience. Over my many years evaluating companies and evaluating consumers, the one constant I found is that people are willing to pay for convenience. They will pay high margins for convenience, and Uber is in the convenience business. It's so much more convenient to order food on the Uber Eats platform than to go and pick up the food yourself. It saves you so much time, and people are willing to pay $10, $15, $5, or whatever percentage of their total order value is. They don't mind paying $5, $10, $15 on top of that to have the food delivered to them instead of having to go and pick it up. It also means you don't have to look for transportation. People sometimes, when they come home from work, they like to have a few beers. And if you've had a few beers, you can't drive and go out and pick up your food. So you can come home from work after a long day, have your beers, and have the food delivered to you without worrying about, oh, I can't drink right now because I have to go pick up food for dinner for all of us, right? So that convenience is proving to be insurmountable. Uber is generating significant growth as a result. And the scale it's reaching is generating great operating income, which jumped to 1.2 billion, up from 172 million in the same quarter last year. Cash flow from operations jumped by 64% to 2.3 billion. And this is an important point. Cash flow from operations and free cash flow are almost identical for Uber. And that's a rarity for most businesses because most businesses, when they generate cash flow from operations, they have to invest back in the business in the form of capital expenditures. Uber doesn't have that, right? 2.3 billion in cash flow from operations, 2.25 billion in free cash flow. Only a tiny fraction of its CFO the company has to spend on CapEx. That's the beauty of this business model. Uber doesn't own any of the cars on the platform. The drivers bring their cars. Those are assets worth tens of thousands of dollars that if Uber had to spend on those themselves, that would be a very large capital expenditure. Tesla, which aims to kill Uber's business by providing the market with driverless cars, has to spend tens of thousands of dollars building each one of those cars. Right. And then if they're not going to partner with Uber, they have to spend even more money on customer acquisition costs. Right. So that's a very capital intensive business model, a very high capital expenditure business model that's not very lucrative. It does not generate high profit margins, and it comes with higher risk because you're never certain that all of those billions of dollars that you put out for those capital expenditures will bring you that return on investment that you hope they would. You invest in that today with the hopes that 5 years later, 10 years later, you're still generating cash flow, but you never know what the future will bring. And when you're investing with so many years looking ahead, there's a rival that can see your business and copy your business or replicate your business and take away some of that advantage you aimed to capture in the earlier days, as you're seeing with electric vehicles, right? Tesla proved that electric vehicles were becoming profitable. And then here comes all of the copycats coming in. Everyone and their cousin wanted to start an electric vehicle company. And now profit margins in the industry are collapsing. Many of the companies are going bankrupt. That's the importance of having a capital light business model. You can grow your business with lower risk and utilizing the assets of your, I don't want to say customers, but your quasi employees in drivers. They bring the vehicles to the platform. Uber gets to generate a return on asset from that platform, from that car, without actually putting out any money for that asset. And one of the areas where you see that reflected in Uber's financials is through its return on investor capital, which has exploded from negative 50% in 2019 all the way up to 21% in the most recent trailing 12-month period. I wouldn't be surprised if this number approaches 40% over the next 5 years because of the factor I mentioned earlier. Uber's not bringing those assets to the platform. It's the drivers that are bringing the asset. So as Uber's profits are increasing, as it achieves larger scale and customers engage with the platform more frequently, its ROIC continues rising. It has no reason why that ROIC will not continue increasing. Of course, with the major caveat of the risks from driverless car technology. So far, Uber's been able to partner with some of the largest providers of driverless car technology, including Waymo. But Tesla threatens to sidestep Uber and go to market directly. That poses a risk for Uber stock investors. That's why Uber stock to start 2025 was selling so cheaply because of that risk. But as 2025 has progressed and as Tesla's driverless car testing has gone, I want to say less than stellar results so far, we've seen plenty of mistakes from the technology, even though Tesla was intensely preparing for this launch, right, in that small geo-fenced area in Texas. They've been collecting data and training their AI model intensely for months. And even in that area with intense testing, their technology is making plenty of mistakes, and already regulators are knocking on their door and asking questions about the safety of its technology. So, if, or I should say, when, because it looks like they will develop this technology, just a matter of how long it'll take and if they'll actually go to market with the camera only technology. I wouldn't be surprised if after a few years of going forward with the camera only strategy, if Tesla pivots and actually adopts radar or LiDAR for its technology as it sees it so difficult to go forward with the camera only technology, not just in terms of the actual performance of the technology, but also how the technology is viewed by regulators. If regulators see that LiDAR and radar prove to be so much more safe compared to the camera only technology, even if it's like like let's say 99.9% versus 99.7%, that 0.2% in regulators' eyes is going to be a big deal. And they're not going to say, well, we should go ahead and approve the camera only technology because it costs less. You think the regulators are going to think about costs when they're trying to approve this technology on publicly uh, traveled roads when they have a viable, much safer alternative in the LiDAR and radar supported technology like Waymo and Zoox and others are implementing? I don't know. I don't know. That remains to be seen. But I think safety is going to be critical. And I think using LiDAR and radar is the safer way to go. And I think ultimately that's going to give Alphabet and Zoox and others an advantage. And if it doesn't, then of course they can also adopt the camera only technology as well. There's no reason why they can't pivot to the camera only technology if it proves to be as effective or even more effective. Alphabet has spent even more money on its data centers than uh, arguably any other company other than maybe Amazon. And so it has the capability in its AI to pivot after collecting the data and doing what they need to do to shift gears if they need to. So that risk is still there with the development of driverless car technology, but it could also be a positive because Uber has to pay a lot of money to drivers right now out of the total overall gross bookings. So if it can implement driverless car technology, that's a big expense Uber can avoid and then spend that money on licensing the technology or partnering with somebody like Waymo. So Uber right now is trading at a forward price to earnings of 32. It's the highest it's been all year long. It started the year trading at a forward PE of 21, which I thought was ridiculously cheap and why I recommended this as the best stock to buy this year. I thought it was a no-brainer to start 2025. I still like the company because it's improving its returns on investor capital. It's adding millions of monthly active platform customers. The business model is very lucrative. And when I calculated my proprietary discounted cash flow valuation model, which I updated today, I actually increased the intrinsic value per share after I reviewed analysts on Wall Street that increased the free cash flow expectations for Uber over the next 5 years. My intrinsic value per share now is $124 compared to the current market price of 93. So there's still significant upside remaining for Uber between now and the end of the year. I own Uber stock myself. I bought Uber, I want to say a few months ago, and I added Uber shares at around $60, $70 per share. Now, I'm getting my data from fiscal.ai. There's a link in the description if you'd like to see charts just like this one. Of course, there's still risks with the driverless car technology, so you should evaluate those risks yourself. If you think that Uber's business is going to be destroyed by driverless cars, then I would not recommend this stock for you. But if you see this as a company that can survive and even thrive as a result of driverless car technology, then Uber might be the right investment for you. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.